Good morning and welcome back to Almus Market Mornings. The dollar index edged lower yesterday as US and Iran seek further talks due to the Hormuz standoff intensifying and reported fresh talks in Pakistan closely watched for any progress tonight. Domestically, India's trade deficit narrowed in March as disruptions from the Middle East conflict impacted trade flows, with both exports and imports declining. And meanwhile, USD/INR continued to trade in a narrow range through the session yesterday. Good morning, Jayaram sir. How should investors read the market today?
Good morning, Ishan. We have had a lot of optimism in the markets, um, although some say it's quite premature. But we've seen the S&P 500 and Nasdaq, uh, have all-time closing highs yesterday. Even as talks emerge that US and Iran will meet once again to further take forward the peace process. And so, apart from that, of course, there were some earning reports which gave encouragement to the uh, yeah, risk investors. And of course, we are still at the beginning of the earnings season, but there's again expectation that earnings will not be impacted at least for the quarter ended in December. For the March, because of war effect will be seen only later. And in any case, in US, the main concern is only about inflation due to the oil price spike. Otherwise, the supply chain issue is not so much for the US because they are self-sufficient in oil and natural gas. So that way, I think US markets have been perhaps the best performing in this whole situation of war. While other markets have also started to look up quite a bit, and we have had Japanese market rally, and then some of the emerging markets, in Korea and South Africa and all, they've all been picking up as well. Now, the key point about the Strait of Hormuz, and it was somewhat relieving to see that Iran statement that they could consider ships being able to sail through the Oman side of the Strait of Hormuz without interference or attacks as part of a deal with the US. So it's like you will have a peace agreement. At the same time, you won't have, the full control given up by Iran, which they will project as their victory. And at the same time, US will also say that they allowed, or rather, made way for shipping route to be opened and oil to flow into the world. So that possibly this is the line that is going to be taken going forward. Yeah, we'll have to wait and see exactly how this process will go forward. But market right now, as I said, are going on a lot of optimism. Uh, and even the White House secretary has also said that the second round were going on with productive, progress. And the ceasefire, permanent ceasefire, was very much on the cards. In the meantime, on the rate side, there is still a lot of uncertainty. Most of the Fed members, in fact, have been quite cautious about the rate cuts, and they feel that the need to watch the inflation trend going forward. And even the growth aspect also needs to be watched because we have seen the employment situation softening there, and the growth numbers for Q4 were quite disappointing as well. So I think Fed direction is quite unclear now. But one can safely say that the rates will hold at this level for much longer. I mean, in the case of Europe also, there is a lot of uncertainty. While market had started to discount a rate hike as early as this month, some of the ECB policymakers are wary of rate hike in this month because they see no evidence yet of second round inflation effects and broad-based inflation numbers as well. So I think markets are watching these monetary policy statements as well as the war situation uh, edging up quite steadily unless it is derailed due to some new negative developments. Yes, there's a lot of macro numbers from India. We had, of course, on Monday the retail inflation, which inched up to 3.4%. Now, yesterday we also had the wholesale price index, which came at almost double of what it was in February, from 2.13 to 3.88%. And this is the highest in more than 3 years. See, till December 25, there was a downward trend, and since then we have seen the wholesale prices also slowly pick up along with the retail inflation. Mainly the primary articles which carry a weight of 22.62% in the index. This was actually the one which was contributing to the higher wholesale prices. So this is something, of course, not a decisive factor for the RBI policy making, but definitely it is an indicator perhaps of how the retail prices, if the pass-through happens, how the retail prices are going to move going forward. Trade data on the face of it looks good. The deficit has come down from 27 billion last month to 20 billion this month. And of course, this is even less than what we saw in December in January rather, which was at 34 billion, which was boosted by a huge amount of gold imports. Now, a distinct feature has been while exports rose on a month-on-month basis, export rose while imports were lower. This was mainly because of constraint on importing the oil from Middle East, which got halted due to the war. So this is a temporary factor. Otherwise, we generally don't have a situation where only exports rise and imports are lower. So on year-on-year basis, both were higher. Then sharp year-on-year dip in oil imports were the cause for the overall merchandise deficit to ease. This is definitely a temporary factor, and going forward, as oil prices stay high and our imports are not actually coming down, our consumption has been quite strong. So I think this trend of higher deficit will continue. Just to throw a perspective on the number, for the full year of financial year 25-26, merchandise exports were higher, just marginally higher at 441 from 437 billion in the previous year, while imports actually increased from 721 to 724. Thus, the merchandise trade deficit was at 333 billion versus 283 billion in the last year. Now, the focus, of course, is on the overall trade deficit, which includes goods and services deficit. There again, the deficit was 119 billion versus 99 billion in FY25. Of course, a lot of contribution to the higher deficit has also been due to higher gold imports in terms of value as well as in volume. So trade deficit will continue to be a concern, while the number for March is lower. That is not a trend, and we'll watch out numbers from April onwards for assessing the trend. Overall, rupee is not really getting much lift from the weakness in the overall dollar index, which has been seen. As we know that banks selling pressure due to their long position has been eliminated on April 10th, and currently we are down to the demand and supply situation. See, one feature of the last few days has been the FII outflows have actually abated. We kind of got small inflows on a couple of days, and then the outflows were much less. But that doesn't make a difference, because India's current account needs a lot of filling by the capital inflows, and that has been really missing. So unless we see a good turnaround there, rupee is not going to make any sustainable gains, and it could remain stable for a period due to RBI's actions. But the pressure on the rupee will remain so long as the capital flows are missing, as well as the oil prices, which are, even if the ceasefire deal is signed today, the oil prices will take some time to come down, because the full oil supply restoration will take a long time. So challenges for the rupee will remain, and in my view, it will continue to underperform. Of course, it could take some time to break the resistance at 94, and 95 is definitely a big line in the sand drawn with the central bank. We'll see how it goes after that. Thank you.
Thank you, Jairam, sir. And just to summarize, a lot of optimism being seen in the markets as the US indices had an all-time closing high yesterday, as positive progress from the US-Iran talks are what the traders expecting. And the Oman side of the Strait of Hormuz is what the Iran is expecting to ships to pass through, with no attacks being done on that side. But yes, still a lot of optimism is being seen, as also the White House secretary mentioning that permanent ceasefire is definitely on the cards soon. And when it comes to rate cuts, most Fed members have been cautious about the rate cut situation, keeping the Fed and also the ECB in a tough spot, as talks of a rate hike were flying across the markets for several central banks earlier. Retail inflation inching up for India on Monday, and wholesale price index yesterday almost doubling, making it the highest in almost 3 years, showing that if the pass through happens for Indian goods, these are how the retail sales can move higher from here. And sharp dip in Iranian oil imports was the core reason for the higher deficit this time, which is also expected to be higher, continuing to be a concern for India. And USD-INR not getting much lift from the overall dollar weakness seen in the global markets. And now we're down to a situation of only a demand and supply as the FII flows continue to stay dry. Thank you all so much for listening, and we'll catch up tomorrow with a fresh round of updates. Thank you.